Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Welcome everybody to another Investing Insights with Steve Waters and Victor Kumar from Right Property Group. We're back for it's the first time in quite some time.
That's right. We got flooded in
3 times. So we got the 1 in 100 year flood 3 times. So that's 3 generations now. We should be good for 300 years, theoretically.
Or is it that bad luck comes in threes?
Well, either way, I'm over it. But like we've said on some of the other platforms, we didn't get wet physically. We were just cut off. Mm-hmm. Do your diligence. Make sure you don't buy in those areas. But there's a lot going on, Vic. There's blue skies. Well, there was blue skies this morning. Not now, for a change. So that was quite exciting. But we've got federal elections that have been announced. We've got war continues. We've got interest rates.
Yep, it's all happening.
We've got doom and gloom merchants who are having a field day. And then there's everybody else. So there's a lot to talk about today. But I thought today the subject is really about burying your head in the sand, because I really do believe those that bury their head in the sand now will pay the consequences later. And this is the time to be upfront and proud and over everything and deciphering what's potentially truthful and what's propaganda. And then you should be held in a good position to move forward.
Yeah, absolutely. And this is where, like you said, if you bury your head in the sand, you're not being proactive. And as property investors, and in life general, right, if you really want to move ahead and make use of the cards that are dealt to you in the best way possible, you need to be proactive and not lament on what you've been dealt, but look at it in the sense of, well, life's given you lemons, make some lemonade. Yeah,
well, control what you can control and everything else you need to act accordingly.
Yeah, absolutely.
I mean, it's not all bad. And I think this is where I think there's a large element of people within, whether it be the media or just the general public, who when there's a little bit of flux within the market or a whole heap of negative media and the potential of what could happen, I truly do think they feel good about that. It's like they get their chance to say, I told you so.
Yep.
And it gives them the warm and fuzzy that perhaps because they didn't do anything and there's a whole heap of regret there, that now this is their time to shine, to say, well, you're going to lose everything. In fact, what was the report that was in one of the major newspapers? I nearly said it then, but I won't.
So one of the major papers basically put out an article saying that certain areas in Sydney and Melbourne have dropped by 40%. Now, misleading article, misleading headline, because when you look through the whole article and you look through the stats, it's actually showing some of the areas they're talking about, it's gone up by 15, 20%. But what they're really talking about was the amount of, or the rate of inquiry had dropped by 40% in some of these areas, not the price. But most people would just look at the headline and look at the first 1 or 2 paragraphs before they lose interest, and therefore form an opinion that the property market has crashed 40% in those areas.
Now, we know that journalist. That's all I'm going to say about that, actually. I stopped myself. Yeah. I started to play the conversation in my own head, and I thought, no, don't go down
So
that.
for all your complaints, it's 1-800-STEVE.
No. Anyways, but never let the truth get in the way of a good story.
That's what it was.
And look, we get it. We understand. We deal with enough media to know that the clickbait headlines drives ultimately revenue, and that nobody really wants to know the good. They just want to know where's the blood on the streets. That's literally. Yep. And how could they sleep better at night knowing that we told you so, if that makes sense. It's a really strange dynamic, because when you go back through all the media for, let's say, for as long as we've been doing it, so since 2000-ish, or thereabouts, 99 for you. And if I could compile all the media major headlines from all the way back through, back then through to today.
So predictable, isn't it?
It is so predictable.
Yeah.
It's just like, well, let's go to draw 3, file 36. We'll pull that one out and we'll run it now.
It's the old click and drag, isn't it?
Well, it is. It's very much that way. And the problem with it is that I think the general consumer is becoming far smarter.
Yeah, and they're getting fatigued. They're getting fatigued with all these headlines.
But they're smarter now because you don't have to be relying upon the daily newspaper to get your information. There's so many more elements, platforms, whatever way you want to look at it, to give you enough information to make hopefully an educated decision rather than the political persuasions of one major information provider.
Yeah, that's right. And if you're investing via daily headlines and investing via media, yes, you'll be all sorts of strife now because according to the media, it's a 40% drop in price. If you just took the headline into account, right? So it's really important to look at it from a holistic point of view, looking at it from how the different snippets of news and the different moving parts actually impact your portfolio and where you're heading in terms of a goal. And this will help you make the decision whether to stop buying, accelerate, take stock, or change what you're buying to take advantage of the market forming in the near future.
And it's different for everybody, as we've always sort of banged on about, so to speak. But coming back to the 40% drop, is it possible? Yeah, it is. Will it happen? Somewhere in the future, we'll probably see isolated pockets or particular properties drop by 40% for whatever the reason. The data won't give the reason, so it's up to you as the consumer to understand what the parameters are behind it. But is it possible? Absolutely. But in today's current environment, as we are somewhere off the back end of what has been a fantastic period of growth, some would like to call it a boom, and we are now having the pendulums potentially swing the other way, or more importantly, what we're seeing is the parameters are changing as a reaction to what we've just experienced. So maybe to put that in a box, if we go back to pre-COVID, where monetary policy was becoming a little less tight, and then as COVID hit, it became looser and looser and looser, and then we had government grants, whether it be because of COVID or first homeowner grants, first homeowner schemes, construction grants, et cetera, that was a knee-jerk reaction to a moment in time, rightly or wrongly. And today what we're having as a worldwide result of COVID is another type of knee-jerk reaction. And it doesn't matter where you are in the world. It's kind of the same things are happening. Like I was reading the news this morning, and I did a bit more from what I talked about a couple of weeks ago around London, and the rate of inquiries through the roof. And now their rents are through the roof as well. In fact, there's been more activity in London than there has been in a long, long time. And is that a suggestion that people are moving back to the metropolitan areas or to the major cities, or is it just a moment in time where people are saying, you know what, all the fundamentals are there for me now
to jump in?
Canada has just banned all foreign investment. The US is doing well. Lots of parts of Europe are doing extremely well. I'm talking about residential real estate here. New Zealand, across the ditch, was doing very, very well. And they brought forward, probably before anybody, some policy changes to slow their markets down. So across the greater part of the Western world, property is doing extremely well. Now, is that a repercussion from COVID? Yeah, potentially it is. But more importantly, people are only going to buy it to provide accommodation if the necessity is there. Like, you're not going to go and buy real estate in a suburb A or region A if there's 80% vacancy rates. So there needs to still be the metric there to want to do it, as well as the funding behind it, which is really the consequence of COVID, has allowed people to do that.
That's exactly right. So when you look at any movement in market, right? So it's driven by the buyer sentiment. So people thinking whether they're going to make money or they're going to lose money determines the behavior. Now, that behavior or that sentiment is actually underpinned by the availability of money, the security of jobs, and of course, the trend emerging allows more people to jump in in a Me Too situation to say, I want to jump into the bandwagon as well, because someone's made money, they spruik about it, and especially today with Facebook, they spruik loud and proud, and everyone wants to get part of the action, right? So when you look at the COVID era, pretty much all countries reported positive growth in property values, bar Bahamas and Malta. Now we don't know what happened there. I didn't dwell deep enough into the metrics there.
Oh, you missed that meeting.
I know.
Yeah.
Yes, but it shows a true to form, right? We were in the midst of a world pandemic that we haven't seen for a century. Yet we had property price growth in most areas. We also had job growth, employment growth, and the economy in most areas was stable. The flow and consequences of it, if you take Sri Lanka as an example, is that it comes back to then the governing body there to then manage it through the recovery phase, because whether we want to admit it or not, with COVID, we're now in the recovery phase of mending the economies, winding back all of these splurge of money that they've thrown. And that'll be interesting times. And when you throw onto that, the fact that we have interest rate rises pretty much happening, and the fact that most investors, if they've been investing in the last 6 years, have not seen an interest rate rise at all.
10 years.
Yeah, 10 years. Yeah, that's right. Yeah. So in the last 5 to 6 years, there have been rate drops. So most investors, take into account that your newer investors or people that have just jumped onto the bandwagon in the last decade, have not seen anything but lower interest rates. And when you look at the fixed rates right now, it's sitting at 4% plus. So there's going to be some new territory that people will step into when they start seeing rapid interest rate rises, which is likely to happen. And you and I have seen this, 7 months in a row of interest rate rises, and that was happy hunting grounds.
It was a beautiful time. I mean, at that moment in time, though, it was like, okay, well, let's just regroup, regather.
Yep.
We had to pivot in some of our, not strategies, but the types of properties to be able to take advantage of a point in time. But as we reflect, it was a great point in time. But coming back to your point about people that have never seen a rate with potentially a 3 in front of it, let alone maybe a 4.
Yep.
I do believe there'll be this psychological moment in time where it will cause hesitation. And the hesitation will be, have I done the right thing? Should I be selling? Will I cope? And what do I do now? So, and when you get the collective to do that, or if the collective happen to go down that path, well,
and you sprinkle them negative media news as well.
Correct. And then it could become self-perpetuating until it doesn't. And what are the reasons why it wouldn't? Well, rents continue to go up. So from commercial viability, it makes sense. Some people will see, and I truly do believe what I'm about to say, I believe that some people will see the opportunity within the market. I actually give credit to investors, thanks to technology, as we've talked about many times. People are far more sophisticated now than they ever have been in our space.
Yeah, information is easy to get to.
Correct. And I believe they're learning to decipher the right information from the not so right information. But as we mentioned earlier on, the bury your head in the sand and pay the consequences isn't all bad. I mean, it might be a case you're missing out on opportunity, or it also might mean on the negative side of the ledger that you haven't prepared yourself with potentially 4 to 5 rate increases.
Yeah, exactly. So put it in perspective. We really have got a 2 to 3 month window to prepare ourselves for this onslaught of interest rate rises, right? And psychologically, it can be a big hit, especially when you start seeing interest rate rises, like I said before, for the first time. But if you spend the next month, 2 months preparing yourself for what is going to happen, you'll be in the box seat to take advantage of a lot of opportunities, whether it is to actually protect what you've already got, or whether it is to actually absolutely escalate your property holdings, because you are now well prepared going into this market, as versus most of the people that won't be as prepared because they're not taking action early enough. And that's one of the things that we found time and time again, regardless of what the crisis is, regardless of where the market was, that if people aren't proactive and preparing themselves for the market change, they get left far behind.
So the 5 minutes prior to the recording, when we were tossing around a few ideas what to speak about today, one of them was what is one of the most major faults that investors have when establishing a portfolio / controlling a portfolio and reaching that end result. And one of them was the control around finances, but above that sat how proactive is the investor.
Yeah.
Are you a passive investor? And we've always said we don't believe that being a passive investor is the right thing to do.
You're leaving money on the table if you're passive.
You're leaving money and opportunity on the table. You could potentially be costing yourself money. But would you have a $500,000, multi-million-dollar business that you don't monitor, that you aren't actively involved in, unless you're Rockefeller and your descendants and receiving royalties? But for the majority of us poor people, we need to be involved in our businesses. And that includes residential real estate. And I just don't agree with anyone who says keep it passive.
Yeah.
So when we are involved in the monitoring and the measuring of our business, being property in this particular case, we get to see the little slithers of opportunity where we've found fault and we can adjust accordingly, or we can extrapolate more income, reduce expenses, be able to capitalize on opportunities, whatever it may be. Or it could be status quo and we can all group hug and high five and say everything is going well. Let's go have a coffee and relax. But you won't know that unless you're into it. And so as we were discussing earlier on, the reason for this particular subject about burying your head in the sand is, once again, it's not just about all negative. It's also what is the positive you could be missing out on in terms of opportunity within your own circumstances. But what are we going to do, and how can we adjust for the elephant in the room, which is rising rates? Let's not even talk about asset value for a minute. Right? Let's just talk about the cost of our biggest expense, being our mortgage, is going to go up. How do we facilitate, accommodate, so that we still get to sleep at night and hopefully perpetuate our portfolios?
Yeah. So if you look at the metrics currently, right? Most people at the start of pandemic in 2020 and beginning of 21, they locked in their rates. So they restructured, they locked in their rates. So your rates are sitting, fixed rates are sitting at, I look at my portfolio, I've got a couple of 2.49s, which is about to expire.
Next year.
Yep, that's it. Mine's actually expiring end of this year as well. So you've got that, plus the interest rate rises. Now, when those fixed rates, because mine are interest only, when they roll over, it'll roll over into principal and interest, right? Because there's a 3-year fixed rate. On top of that, it'll be your standard variable rate, not the discounted one, the standard variable rate. And the standard variable rates, if you look at the banks right now, they're actually sitting at 5%, right? So not only will I have the principal component kick in, my interest rate practically doubles. So if I'm not prepared and I haven't done my cash flow ahead of time, I'm going to be in all sorts of grief if I was totally reliant on negative gearing to help my hold on to my portfolio, and I'll come back to that in a minute. I'm totally reliant on my overtime to hold on to my portfolio, and I've along the way I've fluffed the numbers to make it look pretty, so that I can say that, hey, I'm holding onto a big property portfolio. So I'm bragging on the number of properties as opposed to the numbers on the property in itself.
Yeah, good point.
So this is where proactiveness comes into play, right? So as an example, one of the considerations one could have is that, let's say the fixed rate was going to expire in, say, 6 months' time. We know that the lead time to get a medium-sized portfolio refinanced is probably about 2 months. By the time you take into account the amount of paperwork you need to gather, the valuations happening, access issues, all that sort of stuff. So I know that I've eaten 2 months into the 6 months. And perhaps I may take a proactive approach of taking the 3-month exit fees, if there was an exit fee, on the chin to lock in my standard variable rates, the discounted variable rates for the long term. And it would be unlikely if you look at the fixed rates and the variable rates sitting here right now, that there is probably about 6, maybe 7 blips we can sustain before we hit the actual fixed rates that are available right now. So you've bought yourself a bit of time to manage your cash flow, and you know that the whole lot won't come in on day one. And this is where you need to be doing your sums up front and taking a business approach to it, as opposed to an emotional approach of no, I can't get rid of my fixed rate, or I don't want to go on to a different bank because it's too much paperwork. A lot of the fixed rates that you've got right now, if you've got a few months left, may be well worth looking at it because to refinance it, because you actually don't have, in most cases, a break fee, because the bank can resell that money for a lot higher.
Correct.
Yeah.
And so there's the upsides to that is you'll clearly know what it is if you activate now. Yeah. It could enhance serviceability. I mean, you'll be giving away serviceability to begin with, going from, in your case, from a lower rate to a higher rate, but it's potentially going to be higher than that.
Again, when the rates kick in.
Correct. So if you're only activating once the fixed has finished, you are potentially 3 to 4 months behind that.
You may not even qualify.
And that's my point, right? So the serviceability may change completely. We're only talking about rates here, but what about the calculus in the background? What about LVR or credit policy, essentially? What about if that changes? So once again, we're not being on the negative here. We're just being on the proactive side of caution, I guess, so that we're controlling a situation rather than reacting ineffectively to something when our back's in the corner.
Yeah, absolutely. Yeah, the other thing that you would do, right, if you look at the greater consumer loans that you have, right, so a lot of people have got consumer debts or car loans, car leases in particular, right? There's novated leases that kill your borrowing capacity. You've got perhaps some other debt hanging around. Now would be the time to perhaps look at consolidating these debts to free up your cash. You want to free up money before you actually need it. You have to free up cash flow before you actually need it. So you're getting rid of all of those unnecessary payments where you've got a big payment coming out monthly and you're whacking it into a home loan. Danger in that is that you still need to maintain the current payment to actually smash that loan down. Otherwise, all you've done is taken, say, in a car lease situation, a 3-year debt and transposed into over 30. So you end up, whilst on a monthly basis, far less cash flow, but you'll end up paying far more.
It's an interesting point, when you talk about the novated leases or the unsecured, secured lease, but let's call it car debt. Because as we've talked about before, whatever the loan amount is, it's circa 5 times that.
Yep.
That's eroded from serviceability for real estate. Yeah. So $50,000 car loan, $250,000 serviceability gone, give or take. Because of the situation that we're in at the moment, this is the stuff that I'd love to think about. Because of the situation that we're in at the moment with COVID, low cost of money, supply chain bottlenecks, and I'm talking like bring it back to vehicles now where it's a year's wait or thereabouts to get to a new car. Second-hand cars are more expensive than what they were when you purchased them. Everybody knows the story. But there's been such a tremendous amount, because of cheap credit, of new cars that have been purchased that yet haven't hit our shores. So you might be 6 months away from getting it. And now the monetary environment has completely flipped on its head. So from before, when you were getting 3-4% or even some 0% finance, car loans are going to rapidly increase. So what you thought it was, the time you get that vehicle 6 months down the track, it's going to be hugely different. So make sure that you're prepared.
And your financials would change, right? Because your commitment to your mortgages and all that would have changed.
Everything's
by then
changed.
Anyway.
Yeah, everything's changed. So could there be this inflection point where we see a hell of a lot of vehicles on the market at a given point in time? Now, why is that relevant to realistically what we're talking about today? Because it's the outflow of cash flow.
Yep.
Right? That all adds to the household budget. But if we get to a point in time where rates have gone up excessively and people have bought into the negative spin in terms of their assets, in this case real estate, what are they going to offload first? If they got stuck into a corner, are they going to offload the house, whether it be an investment or an owner occupier, or are they going to offload
the car,
the non-productive asset and the debt associated? It's going to be the car.
Yeah. It's the true off-the-plan purchase, except it's cars.
That's really good. So this is an off-the-plan purchase it's an off-the-production line purchase, but it's a car. We advocate don't buy the off-the-plan purchases. Throw cars into that one as well. For
Absolutely.
Off the plan. The other thing too is...
Sorry, on that vein, right? So because we've just bought a new car, bought my wife a car. The salespeople...
Did you get rid of the other one?
Not yet. I don't like change. The salespeople are telling me, right, you're better off buying a 2021 car as opposed to a 22 or perhaps a 2023 model, because with the Ukrainian war and with the shortage of microchips, the newer cars aren't getting as many mod cons on it as opposed to the 1-year-old manufactured ones, right? So when you bring that to off the plans, right, there's no change in price. In fact, you're paying more. So if you're buying an off the plan apartment, as an example, the developer can reduce the floor size by up to 10%, and you still have to buy it. Right?
Yeah.
And it's the same thing with cars right now.
Yeah. I mean, I think what you're doing there is you're sugarcoating the reason
absolutely.
why you bought the new car, justifying it. But I guess when we try to look at, well, okay, what can we do right here, right now, other than being proactive with our finances? If we look aside at some of the metrics that are being bought out by the banks, people are in front of their mortgages the most they ever have been. Offsets, brackets, best product or facility/product that was ever invented.
Hugely underrated.
Hugely underrated, but a lot of people understand what it is, so they're very full, more so than ever before. Credit card debt is at its lowest it's been in decades, I believe. Watch all that swap. I think, and this is where I believe the consumer might be a little, I don't know, up in the face of the negative narrative that's out there, because, well, we're not living on the bones of our pants.
Bit of resentful spending.
We have buffers via our offset. We don't have much credit card debt. We're in front of our mortgages. Jobs are very good. Wage growth is starting to be there. Rents, if you're a landlord, are going up. There's a lot of good components in the argument rather than, well, let's just concentrate on the negative. But once people start to erode the buffers that they have, watch the credit card debt start to increase dramatically, therefore adding pressure to the households. Now, this is me looking at the negative side of things. And then you might see some household pressure where people start to sell assets, But where I think it will go, all things being fair and equal, and if we don't have Armageddon, which I don't believe we will be, that because people are a lot smarter than what they ever were, because people are now more financially responsible than they ever were, because people have made a hell of a lot of money in most asset classes over and during COVID, that there's still that moment in time where they will resist the negative narrative.
Yeah.
Because things are still good. Jobs are secure. Once again, wages are growing. The economy's in good shape, all things being fair and equal, considering what we've just come through.
Yeah.
There's no real necessity to want to cut your wrists over the situation now. What happens in 3-5 years could go completely any direction. And this is the point, I guess. We're giving our opinion on where we think it is and where it could go, and so is a million other people. But one thing I'm sure of, nobody has the magic answer to know what is going to happen.
Absolutely.
We don't have to go too far back, 3 years circa, where those that said were definitely wrong.
And 30% drops.
30% drops. It's almost history repeating itself again. But also to the bury your head in the sand attitude from the governments thinking that you can print all this money and give all this stimulus and not expect inflation on the backside is burying your head in the sand. And anyone else who took it or even just absorbed it, here's all the grants, let's not worry about tomorrow. And that's the problem. Let's not worry about tomorrow. Let's just live for the now, which is burying the head in the sand.
Yeah.
So get on the front foot and you'll be in a fantastic position.
Yeah, and talking about proactive and free money, there's a lot of businesses that took advantage of the government grants, the 250k loans to boost up your business during COVID, right? They're actually starting to become due now, right? So they need to be repaid or refinanced. So there'd be a whole lot of businesses that if they haven't been able to get back on their feet, they're going to perhaps tack and change immediately to try and refinance or even sell out some assets. So we're likely to see a little bit of an increase in stock on the market as part of this normal reaction. But normally what happens is if you look at it historically, we've got this perfect storm happening, right? So we've got the fixed rates interest only is coming off the boil into standard variable rates, principal and interest. We've got the elections. We've got the talk of the interest rate rise. More than likely, within the next 2 months, we are likely to see some much stronger rhetoric, even an increase in interest rates. So with this normal circumstance, if they came in individually, people would take that in the stride. But because they're all coming in together, most people will want to sit back and say, okay, let's see how this pans out before I do anything. So you'll find a lull in the market, both from a refinance point of view, in terms of purchase, in terms of people whacking properties on the market to offload the heavily negative cash flow properties that they're controlling. For the next couple of weeks, there's likely to be less properties on the market worth buying from an investment point of view. There may be more lifestyle properties popping up.
That's a good point. Yeah, and let's just clarify that, because I think the volume of properties will be greater, but the amount of decent properties is a different story, because we've just had Super Saturday, Super Sunday,
yes,
where it was huge numbers across Australia going up for auction, which is the quasi barometer for the tempo of the market is the auction results. And not surprisingly, Sydney and Melbourne were the lowest clearance rates at circa 69%, which is still
huge,
bloody healthy.
Yeah.
You had Brisbane and Adelaide's and I think Perth into their high 70s and low 80s, which is massive. Compare it to this time last year, though, but back to Sydney and Melbourne when the market was at its most buoyant, and you had Sydney and Melbourne at circa 80% or whatever it is. So, when you look at that headline statistic, it's been a drop of 10%. And if you were that way inclined, always looking at the glass half empty, you'd say, well, this is the beginning of the end.
Yeah.
But it was the biggest weekend, always is traditionally just before Easter. The volume, put it in perspective, the volumes of properties that went to auction and that were sold under the hammer or directly afterwards is still
higher than before.
Very good. It's still, and it's held solid over the last couple of weeks. So it's not a bad situation to be in. And but when you start to isolate the regions across the country, well, some are so healthy, so strong, so buoyant that you can't help but not look at it. You can't ignore it, right? Now, obviously the big elephant in the room as well that the governments, neither the federal, the Liberal or the Labor Party are talking about is how to fix the problem of a lack of accommodation.
Yep.
Right? And we've been going on about this now for months, about this crisis. In fact, I saw a report that the vacancy rates from SQM end of March were the lowest in decades. So 2006, generally speaking. And we did I think it was a Facebook Live a couple of weeks ago about saying how this is a bigger crisis than the GFC in terms of accommodation, and this could potentially be multiple generations in terms of how bad the undersupply is that we've ever seen.
Best time to be a landlord.
Yeah.
With the right property.
Yeah, and ethically. Don't be a slumlord. # It's but these are all the things that are going to underpin, coming back to the subject, going to underpin our ability to be able to control the debt, therefore the asset. So it's not just about getting ahead in terms of the interest rates, and in your example of act now, act hard, act early, but it's also about the income side of things. So keep in line with market rent. When you have a market that is so undersupplied, the elevation of rents is weekly in some cases. So you need to be always involved with your property managers, and we spoke about this before, challenging them doing your own DD to make sure that you are keeping up with market. And even those incremental increases will help control the asset and give you that sleep at night factor for the future. So there's interest rates, there's income being our rent. What about insurance? And this is the big disclaimer, not giving you any advice there. Shopping around your premiums, making sure it's the right, check the PDS, apples for apples.
Yep.
Increasing, you might be finding that you're paying more, and so you should, because the cost of replacement's gone up because of construction. Or it might be about property management.
Yeah.
There are so many different facets that you can become involved in that are in your control to help the bottom line, as opposed to, once again, burying your head in the sand and being, it'll be what it'll be.
That's right. I want to address the property management and the insurance, right? Be very mindful that you don't get caught up in the percentages. So often, a 5% management fee as opposed to a 6% management fee. People generally tend to gravitate towards the 5%, but you need to look at it at what cost. Right? How proactive is the property manager? Do they hold a diverse portfolio of properties? Are they close enough to the property itself? And more importantly, how proactive are they with essential repairs as opposed to good to have repairs as well?
Especially with versus the need.
Yeah, that's it. Especially when the costs for repairs is going up and up and up.
Yeah, but that's the whole point, I guess, I was trying to make, is just because it's cheaper doesn't mean it's more consistent. Correct. In terms of your cash flow. But as a side note, and I'm an advocate for this, is I prefer my property managers to be in the locality where my assets are. I've never really successfully had property managers, and all the hate mail from the property managers can go to Victor Kumar at complaints. I've never really had too much success in having property managers that are outside of the locality where the asset is.
I agree.
Yeah. It just doesn't seem to fit well. And I know there'd be an argument to say that it could.
Few and far between.
I've never had a good result from it. So once again, do the diligence.
That's exactly right. And so if we look at it from, what can we do? So we've talked about, obviously, look at debt restructure well ahead of time. And in fact, your window is within the next 2 to 3 months. And if you don't know where to get started, reach out to us and we'll put you in touch with our team at MLS to give you some independent recommendations. And sometimes it may be that it's not feasible, nor is it financially smart to do a restructure. You may be on a good wicket to begin with, and you've got plenty of time on your side in that sense. So you restructure your debt. You would look at, obviously, the running cost of your portfolio, right down to the T, right, in terms of every aspects of it. Then you also need to be looking at, okay, what am I doing in terms of the portfolio itself? Do I bring forward a construction to mitigate that interest rate rise? So if there's a granny flat site parked away, I know the cost of construction at the moment is higher, and the time to do the construction is longer at the moment. But if you play this out, does this mean that by constructing that extra dwelling, it keeps your household budget very fluid, and it also allows you to continue borrowing and therefore do a restructure down the track when the rates are higher, and especially going into a very strong rental market with very low vacancies? Your granny flat, even though you've got or granny flat or secondary dwelling, even though you may have a higher cost, your rent that you can command would generally be a lot higher than what you've done the numbers on before. Then the other thing that you perhaps need to look at is, and this is with a couple of our clients, we have helped them in this scenario, is that it may be time to sell some of the dog properties, right? In that sense. So let's say you've had you're heading for a very strong change in your family situation. So you're getting another addition to the family. You got a child on the way. One of you is going to be off work for 1 year, 2 years, depending on how things pan out in terms of looking after the child. Would it make sense to offload one of your properties to have a large cash buffer in place? Now, this is something you need to obviously sit down with the accountant, work out all of the numbers in conjunction with us, so that you can take a proactive approach. And sometimes this is where when you follow the journey of a good investor, sometimes they take a step back to be able to move 3 steps forward. Yeah.
Sometimes that might be a period of consolidation.
Yes. Not buying anything.
Yeah, correct. And because you can't always purchase, and largely you're dictated to by finance.
Yes.
I guess, whether it's your own personal finance.
That's your fuel.
Yeah, or whatever the bank's going to give you. As we've often mentioned, there's 2 types of finance. One is what the bank tells you you can afford. Second is what you know you can afford. Sometimes they're not even close.
Yep.
Even on the same page in terms of where the truth lies. And the reason that's so important is because before you buy the asset, you need to buy the debt. Before you buy the debt, you need to be in a position to be able to afford the debt.
Yep.
So really it's about investing between the flags and making sure that you've got your house squared away by acting early, being proactive, and then making very strategic and methodical steps to move forward. And if it means that sitting on your hands is the best thing to do for you, then sit on your hands.
Yeah, absolutely.
Still work in the background, prepare yourself for what the future holds, because you can't always control the situation, but you can control your attitude towards it.
Yeah, yeah.
And there's no better time than we have now to prove or to activate right now.
Yeah, absolutely. So let's say that you had no intentions of buying. You know your portfolio is complete. You've got a change in circumstances happening in terms of perhaps employment, or you're heading towards retirement, early or planned in that sense. What's the next best thing to do right now? Off the back of this really good market run, it may be time to actually liquidate your equity. So in other words, liquefy your equity so that you're able to have that cash handy, just in case you have the deal of a lifetime drop in your lap because of the market changes, right? Going into a market like this, you need to have a lot of cash behind you to be prepared to take advantage of the opportunities that may pop up. It's always like we keep saying, it's always good to be prepared for an opportunity and none come by, rather than being unprepared and have opportunities smack you in the face.
All the time. There's some people out there that believe over the next 6 years that we could see 100% increase in some areas or some localities' property value.
Yes.
Do you buy into that?
Look,
big question. I just put you on the spot.
Yeah, you did, right? I'm starting to think, okay, which area? Yes, there would be that possibility, but also the reverse could be true as well, right? Now, on that vein, people are saying that there's going to be a massive drop in rents once we get an oversupply, massive drop in prices, right? That will happen if the fundamentals aren't there. And the example of Port Hedland comes into mind, where we had this huge run during the inception of the mining phase there, huge run of rents. And the rents, because it became commercial in nature, the values went bang, bang, bang. So your 300K properties all of a sudden became 1.5 mil.
Yeah, I remember.
And your rents from $300 a week became $1,700 a week, right? So people bought into that, but the fundamentals weren't really there in that sense. So when the fundamentals got, when the fizz went out of the market, when reality set back in, the financials got ripped out of that market, in the sense that you could no longer rent out the property for $1,700 a week. It reset back to a $300 to $400 a week.
Couldn't even sell them.
Them because most people were buying properties, had bought properties at say $300-400 off the newfound equity. They've now gone and refinanced and perhaps used it for lifestyle, perhaps used it for other speculative investments. And now they're stuck between a rock and a hard place. They need to service this debt of $1.5 million. The amount of cash flow that's come in has dropped significantly.
Banks might have called the loan.
Could have called the loans, yeah. And you've got lower rent coming in, and now your home is at risk because your cash flow is very tight. This is why we're saying that you need to take a strong, hard look at your portfolio. And I know that our listeners aren't caught up in this, but there may be scenarios where you could move your money to better places today.
Ultimately, the dollar has to be working for you somewhere. I mean, they say cash is king. Cash is not king. Cash flow,
yes,
is essential.
That's a good one.
Yeah, but you got cash, it's losing
It's losing
4%,
losing value.
or whatever the inflation is at the moment. But I think there will be stories of Port Hedland-esque stories.
Perhaps not that spectacular, but it'll be there.
Not that spectacular for sure. But there will be stories.
Yes.
Somewhere in the future. But it's remarkable that even areas that only 18 months ago in the news, let's talk say inner city units that were struggling to get an occupant, and they were free falling, not just in terms of value, but in terms of the income they produced.
Yep.
Now we're getting, in some areas, in those inner city locations, are having almost fights on the front doorstep at inspections from potential tenants offering $100, $150 a week more and 6 months prepaid rent to secure the property. How quick
it's turned back, isn't it?
how things can turn around. The days are long, but the years are short.
Yes.
And news, once again, going all the way back to the beginning of the conversation around technology and people far more sophisticated now, the time differences between highs and lows, peaks and troughs of the market and the news that surrounds it is far shorter.
They're compressing
Than what it was many, many years ago.
That's a good point, Steve. So if you look at it from a market point of view in a peaks and troughs, right? So if you look at your major markets, Melbourne, Sydney, Brisbane, maybe throw Perth and Adelaide into that as well. In the yesteryears, the markets were longer. So between a peak of the market to the next peak would take a decade, generally. Yeah, but now we're seeing them far, far shorter. In fact, I dare argue that it turns around within 3 years.
Yeah, potentially. I mean, there's always some areas that will take longer.
Yep.
Or conversely, they may be shorter.
Yes.
Whatever the sort of reasons behind it. But ultimately, the distances between peaks and troughs are shorter. Absolutely they are. And it is because of the technology and the ability to transact. So I mean, property's become democratized now. It's far less a clunky asset than it ever was. And so too is the education behind it. And there's a lot of good educators in the space. There's a fair few not so good ones as well. But actually, that just, as we close, because I know we're running out of time, remember years ago we did I'm not sure if it was a podcast or was it a blog, where we talked about the worst investment strategy that you could deploy, and that was the living off equity scenario. The people that continue to do that are coming into a moment in time where they're going to get caught with their pants down. And very quickly, living off equity is your property increases in value, you tap the equity within it. Victor's choking. You right, mate? Do you want to?
I need a break.
Do you want a blanket? Basically, as your property grows, you utilize, you draw down the equity within it, and you live off the equity. So there's never an end point to the debt scenario on the property. It continues to rise, and you keep harvesting the equity to live on. That's your income. Yeah. And it is the main strategy of a few very well-known people within the industry, and we've always been so against it, tried to debunk it. We've been very verbal about why it cannot work, and we are coming into a moment in time now around harder, tighter credit policy, rising rates, valuers who are becoming a little less buoyant on the market, and it'll be those people that'll be against the wall before most.
Absolutely. And the biggest fault with this strategy is that you've got to continue qualifying for loans, and no one talks about who's going to service the debt in retirement, what happens in retirement. And we are a strong advocate of take minimal debt into retirement. That way you are actually free from what the economy is doing to a degree, and also free from what the interest rates are doing, because you own the bulk of your portfolio outright. Nothing beats outright ownership, right? And it is a process in that sense. Initially, you take out a lot of debt. Then you need to work on the debt itself to pay it down as much as possible, transitioning into retirement. And it is true for some, you may be taking debt into retirement if you started your run too late or later in life. There are instances where we would probably say that, maybe the run is too late, but each person, depending on the age bracket and the employment and the assets that you have behind you to start the journey, the strategy that we employ is very different, right? So I guess, and we've mentioned this in previous podcasts, this is probably one of the prime reasons why when a client wants to use our services, you and I insist on talking with them personally to help set the strategy so that we can truly understand what they've got on their plate, the cards they've been dealt with, and being masters of the game, we are able to then say that, well, you got to play this card first to be able to win it in that sense.
And the card may be nothing to do with property.
Yes.
And there's been a couple of instances recently where I've referred on to some financial planners, good financial planners, because I didn't think they were in the position to be able to purchase property. Should they? They shouldn't be purchasing property. And I can't give that advice, so I gave them, recommended them the financial planners, and they concurred. Because it's not always about property. There's a good other deal of other assets that could be just as lucrative for you, I guess. Just that property is our flight to safety. It's our specialty. Now, as we close off, we know a lot of other people have spoke about the budget. We deliberately haven't, because we want to see who retains or wins the federal election, because
that will come into play then.
It'll be a completely different conversation then. It has been talked about to death, and I think there's been some good commentary around it, and there's been some not so good commentary and how it can affect the asset class we speak about more so than not. But we'll do something once the election is over with. We also, in this particular subject, today's podcast, we haven't talked about the inflationary measures that could not affect property and where it could go to from there, and whether you should have cash in the bank, whether debt, whether property's the good asset. We're leaving all of that alone because we don't want to overcomplicate the basics of what you can control rather than worrying about everything else at this point in time.
Absolutely. Well, that was this fortnight's podcast.
Good to be back in the real studio.
Yes.
I know.
Yeah.
So we do our fortnightly Facebook Lives where we get to answer a lot of questions as well, Vic. And that will be next week. We're looking at each other saying, hang on, what day is it today?
So it is the second Thursday of each month that we do our Facebook Lives. And if you have any topics that you'd like us to address on the Facebook Lives or even the podcast, reach out to us on our socials or send us an email on questions@rightpropertygroup.com.au. Do share our podcast with your friends and family. We'd love to think that we're adding value to people that are just starting out on the journey or people that have got a portfolio. Now, if you wanted us, that's myself and Steve, to look over your portfolio or set you up to invest in today's market, go to our website. There's a contact us form. You can contact us that way. You'll initially talk to Melissa Matheson, who is our client liaison officer. Huge experience in property. She's got multiple properties, been investing for quite a while. She will then obviously get you prepared to get the best out of the meeting with either myself or Steve, and then we can go from there.
Yeah, it's a fair bit of information to collect because we want to give you and ourselves ample time and not waste that moment. So give as much information as what is necessary, I guess. So that's it, Vic. Another fortnight done. We will catch you in a fortnight. This time it'll be with Phil Tarrant from Momentum Media, where we'll get to be across a few other different subjects. So we'll catch you then.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.